Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Okay, unfortunately this channel has not grown quite as fast as I'd hoped. Well, perhaps I should say I'm not making as much from YouTube or Patreon as I'd hoped. But I'm obviously not doing this for the money. I had to find an outlet really, as I think my wife had had just about enough of hearing about Tesla and Elon all day. In fact, I wish you could have seen her face when I tried to explain to her that Tesla actually don't even pay me. I've also taken some more advanced accounting advice, and along with that, I'm now rethinking my LEAPS strategy. I know a lot of you are also into LEAPS now, and partly through my encouragement, which is nice to hear. I think of this channel as somewhat of a crowdsourcing way to invest in Tesla, so I really would appreciate your thoughts on my ideas. We have the ability to run by various strategies where perhaps tens of thousands of like-minded people will hear me out and then offer their credible opinions on what they think. I then read all your comments and take them all on board and evolve my ideas and await further feedback. I really do read just about all your comments. If I've liked your comment, then I've read it, even the long comments, as everyone seems to offer great input. As you know, I'm not someone who sticks to one idea and tries to validate it continually. I'm happy to evolve on whatever is the most right. As Elon says, be less wrong. That is valuable. People on Wall Street do not have these resources. This is a new level of investing. Anyway, I still think LEAPS are very undervalued, and the market has not quite caught on yet as to what a powerhouse Tesla is going to become. My initial thoughts have been to accumulate as many Tesla shares as I could and then leave it there. My strategy was to buy LEAPS far out enough that by the time they expire, then I could afford to exercise them. But I might be leaving money or Tesla shares on the table here. I'm now thinking of just buying LEAPS whenever the stock price is down and use some of the money that I was going to use for exercising them to just buy more LEAPS instead. What these LEAPS are likely in reality are investments that stand a chance of 5 to 10 times return in perhaps a couple of years. And maybe that's how we should view LEAPS with first principles thinking. Now, I've been playing with options lately as they are a lot of fun, but they are risky and it is bordering on the side of gambling. Whereas LEAPS allow a lot longer of time for the stock and company to grow, I find them less risky. And although this 5 to 10 times return might take 2 years rather than 2 months, it's still an exceptional return. The thing is, if you totally cash cowed Tesla as a company now and excluded the likes of depreciation, amortization, and just focused on what Tesla could be if everything was focused around profits rather than growth, then I kid you not, Tesla may currently be trading at a PE ratio of around 50, going by what Q4 profits might look like, and the current stock price. But there is so much more growth about to occur. However, it does take time. The auto tech industry cannot move anywhere near as fast as smart devices or websites or cloud-based businesses. Auto manufacturing is incredibly capital intensive and requires massive factories to be built. In addition to that, an EV requires so many batteries that it takes a very long time to produce that level of quantity. On top of that, there was not really any specific EV battery really created up until the 4680 battery. Although some of the LFP batteries in China are getting good levels of production and prices are becoming more affordable. But bear in mind, this year, when the LFP patent expires in China, then LFP batteries are likely to be produced from a lot of other international battery manufacturers, including Tesla. As we know and are told on a continual basis, that Tesla is moving and growing at exponential levels. If we count 2021 and potentially 2022 as 2 years that will very close to double production of vehicles, then this exponential moves at a very rapid pace. It won't be long until we get to 2023 numbers, which could possibly double again. Therefore, if you can lock in today's Tesla stock price in 2 years' time, i.e. 2024 LEAPS, then there's a good chance that Tesla's stock price has increased significantly by then. Remember, even doubling the number of cars produced does a lot more than double profit, since the overheads do not increase at the same rate as the growth, thus further improving operating margins. Not only that, there is new technology coming out, such as Tesla's 4680 batteries, and perhaps even Tesla's own in-house LFP batteries by 2024. These will both reduce the cost of the vehicles, further improving gross profit margins, assuming Tesla's prices will not come down and the demand holds strong. But even if Tesla's prices do reduce slightly, they won't come down as much as the cost savings of their new batteries. Teslas are exceptional value for money, So there is that to factor in. Now, if we're talking about 4 times as many vehicles by 2024, that also equates to further economies of scale, reducing costs of manufacturing even more, especially if it's higher volume production on the same lines, using more shifts and faster processes, which are continually improving practically day by day. Bear in mind, the more factories, more lines and more shifts will mean these improvements and tweaks to the manufacturing process will simply occur that much more frequently again, and thus the processes will improve at an even more rapid rate. Then there's a good chance that Tesla will add more vertical integration. Who knows, Tesla may even justify the likes of their own semiconductor fab, although I'm not sure, as supposedly they take a very long time to construct and get up and running. I'm merely presenting that as an example. Alright, a lot can happen with this company in 2 years. I think as a result that by the time 2024 rolls over, there's a high possibility the stock price could be somewhere between $3,000 and $5,000. Now, this is a great return with shares over that time, but if you use LEAPS instead, then it becomes significantly better. Rather than 3 to 5 times return, you may be looking at more like 10 to 15 times return. These are absolutely crazy returns. Now, my previous strategy was to exercise my options, which meant that I needed to make sure I had enough funds to exercise these options when the time came. But this could actually be a huge opportunity cost, saving the money to exercise them rather than using said savings to buy more options, which I could then sell anyway and then use the profits to exercise the other options, if you're following what I mean. However, part of the reason I bought these options was to allow me the time to save enough money to afford to exercise them. But I can always find more funds for more options by simply selling some shares. Yes, selling Tesla shares, which will likely increase in value 3 to 5 times, but instead purchasing investments that could increase perhaps 3 times as much as that again. This is obviously a much better return. My current LEAPS have already been up as high as 5 times, and I've only held some of them for half a year. By the time they expire, they could be up as much as 20 times. The stock price could be at $3,000, and my cost of exercising may only be around $700. That's $2,300 difference. If I sold one contract, there would be enough profit in there to exercise about 3 LEAPS. In other words, if the returns are this good, then the sale of the LEAPS could generate enough profit to cover the cost of exercising the others. Alternatively, do I sell these LEAPS and rinse and repeat and buy even more LEAPS another 2 years out? After taking some further very expensive tax advice, it would appear that I do not have to pay tax when I trade. I simply pay a sort of holding tax. This is not the case for everyone, but it does make me rethink what I'm trying to do. Let's run through this scenario and just use some easy numbers. Let's say you have 1,000 shares. The stock price is $1,000 and you sell 100 of your shares, or 10%. Now, I like the look of $1,100 strike price for Jan 24. It's currently $342. Let's just massage that number down to $333 to make our numbers easier. Why 333, you may wonder? Well, that would give us 3 contracts if we sold 100 shares. Selling 100 shares would give us $100,000 cash at $1,000 stock price, and each LEAPS contract is $33,300 because there are 100 shares in a contract. And let's say the stock price rises to $3,000 by 2024. This makes the intrinsic value per share in the options contract $1,900, i.e. the option is $1,900 in the money. A total profit of $570,000 for all 3 options. Now, you can exercise each contract for $110,000, i.e. $1,100 strike price times 100. So if you sold one contract, you would have $190,000, which would just about be enough to exercise the other 2 at $220,000. Perhaps by 2024, you've managed to save a further $30,000 to achieve this. Now, instead of having 1,000 shares, you now have 1,100 shares and minus $30,000. However, those extra 100 shares are now worth $300,000. So all in all, your total profit from having done this would be $270,000. The rest of your shares are now worth $3 million, so this is a 9% improvement. But if the stock price went to $5,000 and did the same, selling 1 and exercising 2, you'd be left with $170,000 profit. And those extra 10 shares would now be worth $500,000. And your total profit now would be $670,000 from this strategy. The rest of your shares would also now be worth $5 million. So this is a 13% increase. I mean, this is just one way to look at it. Other people may have $100,000 cash to invest in LEAPS anyway, or cash to buy as many LEAPS as they can afford. If you simply invested the cash into LEAPS instead of shares, then you basically end up making 3 times as much. as you control 300 shares instead of 100 shares. And then once the options come up for expiration, the question is, do you do the same again? Except this time you could use the profit and now perhaps afford 3 times as many options again, 9 contracts with another 2-year expiry date. But how much more would you expect the stock price to rise again? I've obviously spoken to a lot of people about what they're doing with their leaps, and everyone seems to have a different strategy. Some people like to buy deep in the money leaps and thus not pay as much of a premium. So let me know what your strategy is for your leaps. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.